Mluvím jen trochu češtiny, takže dnes budu mluvit anglicky. Hello, I'm Mark Robinson, Head of Asset Allocation at Encore Wealth Management. And despite my relative lack of Czech, I have been working with Encore for 6 years, over 6 years. Before that, I was an asset manager at JP Morgan Asset Management, as well as head of research and stockbroking at Wood & Company, and also UniCredit in London. But today, my topic is on the concept of active versus passive investing, which is actually crucial both in looking at stocks and shares, but also looking at overall asset allocation. And today I'm going to really take you through what the differences are between active and passive, and which are perhaps better for looking at constructing portfolios. Indeed, this is what we do at Encore Asset Management, is construct portfolios for clients from a top-down tactical allocation basis. So first of all, what's the difference between active and passive investing? On the active side, investors compete against each other. It's a race. It's the first across the line that wins the race. Active investors buy and sell stocks and bonds based on their own research and expertise. They think they're better than everyone else. They think they're faster than everyone else, and they will get to the line first. The aim is to beat the market, is to beat everyone else. On the passive side, everything is the same. Passive investors buy a basket of stocks or bonds. They select a preset index to follow, for example, the US S&P index or the Euro Stoxx 600 stock index. They select an index and then they follow it. They don't try to beat it. They stand together with the index. The aim is to match market performance, not to beat the market. This is the difference between active and passive. What are the advantages of active investing? Well, you can invest in a star manager. I'm not pretending to be him. Warren Buffett, the most famous equity investor in the world, now aged over 90, still performing, still doing his job extremely well. If you select the correct manager, you will beat the competition. He does solid research, correct portfolio construction. This creates great returns for his clients over decades in the case of Warren Buffett. Active investors can tell stories. They're quite exciting. Much more exciting than boring passive managers. And the results are there in terms of the stocks you might invest in. If you put your money in Tesla over the last decade, if you put your money in Apple over the last 20 years, or if you did, as I did, put your money in LPP, which is the company, the Polish company that owns Reserved and Croptown and the other shops that you'll find in Czech and Polish shopping centers. LPP shares were listed at 50 zloty per share in the year 2000 and are now at 10,000 zloty per share 22 years later. Quite incredible returns. So if you pick the winners, you can make lots and lots of money. And this is what the best active managers do. That's the advantages of active investing. But you have to select the right manager, because if we look at performance of active managers around the world, they generally are worse than the benchmarks or the indices that they follow. So on this chart here, we've got the performance of active funds in these asset classes around the world. On the left-hand side, active funds. And then we've got passive funds. The passive funds are following the benchmarks. As I said on the first slide, the passive funds are just following the index. So this is the US large cap index performance, 12.5%. Active funds only, on average, made 11%. So the passive funds beat the active funds by 1.6% on average. That's the average funds. Half of the active funds got less than 10.9%. So this means that active managers generally have not done their job in all of these categories where the numbers are in red on the right-hand side. So the passive funds are mechanically buying and selling to match the benchmarks and obtaining this return. The active funds have not been able to match them around the world. So you have to be good at picking the right active manager if you want to invest in an active way. Otherwise, the safe way, or the safer way, is to invest passively and buy the index. Now, what does that mean? We have more certainty, which in my language is less risk. More certainty, less risk. I'm taking less risk. I'm not racing in that race I showed you on the first slide. I'm standing with everyone else and understanding what return I will get, probably. So there's less risk of bad performance. I'm not going to invest in the bad managers on the active side. It's a fact, in the US large cap arena, only 11% of managers over 10 years beat the benchmark. Only 11%. Quite extraordinary low number. So 9 out of 10 managers did not beat the US stock market over the last 10 years. In terms of less risk, the risk budget and volatility is much more under control in the passive area. We understand the level of risk we're taking. There's a certainty of activity. So as I've written here, there's no changes of manager. So you're not changing your strategy every 2 or 3 years. So it's a lot simpler to understand that you're getting a return that's something like an index. And also now, there's many vehicles. There's many exchange-traded funds, ETFs, to choose from in the marketplace around the world. There's over 1,000 of them that we or other managers can buy, instead of having to invest in active funds. So the passive universe has grown and grown and grown, particularly over the last 20 years. And one of the reasons it has grown is that it costs less. So on this slide, I've got 2 lines. And 2 lines with a 20-year investment horizon and the returns. We start at 100. The only difference between those 2 lines is the cost of investing with an active manager and with a passive manager. Both of the lines, you get 4% per year return. So over the year, each year you get 4% more every single year. With the black line, you're paying 0.9% total expense ratio as a cost. So you're paying an active manager 0.9% fee every year. And I don't know what fees other people in this conference are talking about, in terms of what they are charging each year, but say 0.9 is some kind of average. That's what you get at 4%, but them taking 0.9% off you each year as a cost. Now, most ETFs around the world are much lower cost. So the blue line is a passive ETF with a 0.2% cost per year, total expense ratio of only 0.2%, so 0.9. That is the only difference between these 2 lines. The black one 0.9, the blue one 0.2, and you can see over 20 years, you've made 30% more, 30 percentage points more return simply because you bought the ETF and not invested in this mutual fund where you're paying 0.9% to the manager. So from a cost perspective, this makes a lot of sense in terms of investing in passive funds. So that's actually quite a big advantage in the long run. You can see the advantage, it's very clear. Now moving on to asset allocation. I've just talked there about investments in general, particularly stocks and bonds. Now I'm going to talk about asset allocation. I'm just going to tell you what the difference is between passive strategic allocation and active tactical allocation. Passive strategic allocation is simple, that you take an asset allocation and it stays fixed. So I say, okay, I'm going to put 40% in bonds, 40% in equities, in shares, and 20% in real estate. And we fix it. Doesn't change. Doesn't change forever. So it just stays like that. That is passive strategic allocation. You just keep the proportions, keep the percentages exactly the same through time. That's passive. What's active is actually you have a range of allocations and you move between the ranges. So for example, this example we got here, bonds between 20 and 60%. So the average is 40%, but we're moving between them tactically. It's tactical. Sometimes I don't like bonds, sometimes I really do like bonds. So that's the difference between the two in terms of how you approach investing in these different assets. You might have a benchmark that you're neutral, a neutral level. Say this is a neutral level in bonds, 40%, and you vary between 20 and 60. So you're sometimes underweight bonds, sometimes overweight bonds. This is how active tactical allocation works. The reallocation can be done at regular intervals or irregular intervals. At Encore, we do it regularly. So what are the benefits of active versus passive allocation? On the active side, the first thing is that you have a greater level of control and influence. Like when I showed you that strategic allocation, you stay 40% in bonds. If you did that last year, you would have had a disaster. We obviously saw very, very poor performance from bonds in 2022. So in an active portfolio, you have a greater level of control and influence. As a manager, you can actually decide to change things tactically or have a discipline to do so, which allows your investing expertise, hopefully, to add value to your clients. It allows proper and precise risk control. Risk control as an asset manager, as a cross-asset manager, I can tell you, is very, very important. Risk control. It allows flexibility and space for ongoing innovation. The world changes. Investment asset classes change. So if we have a tactical rather than strategic allocation technique, we can change our approach as needed, as the markets evolve, as they change over time. So this is generally good for shorter or medium-term horizons. Where is passive allocation better? And why? It's a hands-off approach. It's a discipline. It's not relying on someone executing active allocation well. It's a hands-off. You know what you're going to get over a very long time. So that means it's better for investors who are too emotional. Emotion is the enemy of all investors. If you buy high and sell low, which often happens, you panic when the markets go down, that's not good. That's emotion. So having a hands-off approach is good for investors who are too emotional. It works for less experienced investors. If they don't know what they want, it's better for them to be in a strategic allocation technique rather than a tactical one. There's less trading costs. It's simple to implement. That's another advantage. And therefore, also for the long-term investor, it's also good that it's looking at a horizon 20 or 30 years out. If someone has an investment horizon in a very, very long term, it can actually work. Strategic, passive allocation. So that's the advantages and disadvantages of the two. There's a balance between the two. But at Encore, we deploy tactical asset allocation. But what we do is we use passive building blocks. So what I described to you at the beginning, including the cheaper costs, is that we use ETFs, exchange-traded funds. So here's our load of equity ETFs that we use. Here's a load of bond and commodity ETFs that we use, building up our portfolio. On the right-hand side, we've got some active blocks where there's not ETFs, there's not exchange-traded funds that we can use to invest in. So we use all of those to create a portfolio. Now, we do that via a model that I've built, a tactical reallocation model. It's reviewed every quarter. So every quarter, we reassess these blocks. We work out which we think are going to outperform in the next quarter. The model utilizes, as I've written here, leading indicator signals to weight these different blocks. make one bigger, make one smaller, and so on. And then that leads to our portfolios. What are the results of this? This is a typical for a conservative investor, so a low-risk investor. This is the average weight in our Czech crown-denominated lower risk conservative strategies. You can see high weightings in cash, Czech bonds, and international bonds, amounting there to over 60%. Over 60% of portfolios are in cash and bonds on an average basis in our conservative strategy. Equities, only around 13% on average. So quite a conservative build there, 7% in commodities, and then some real estate and some private equity to round it off. This is quite a diversified but conservative approach. That's the result of, on average, of what I showed you on the previous slide in terms of building up these blocks. On the high-risk side, the dynamic strategy, much more in equities, as you might expect, more in commodities, less, therefore, in cash and bonds, only around 30% on average in bonds and cash in the higher-risk portfolios. We also use, as well as those passive building blocks, we do use some products, some of which we generate ourselves. We have a fixed income strategy fund that I have been helping running now for almost 5 years. It's 2 months short of 5-year track record now. Encore Fixed Income Strategy, it's a Czech FKI. We have a liquidity reserve product for our cash weightings, and there's a private equity fund of funds coming for, at Encore for looking at the alternatives asset class. So dynamic strategy in particular can diversify into the PE fund of funds. So those are some products that we are using to invest in some of these asset classes, but the rest are invested via exchange-traded funds, via ETFs. And we access those via Frankfurt, via London, even via New York, in terms of then trading through the stock exchanges. And then what's the performance result of this hybrid approach? On this chart, the passive strategic allocation approach is the gray bars. The gray bars are our benchmarks, and our benchmarks are made up of a mix of Czech bonds, Czech equities, global bonds, and global equities. A mixture, depending on which risk level, a mixture of those, and it's generated a passive return. The benchmark is just investing in those and staying fixed in those over time, those major asset classes, and delivering that return. So therefore, what we have delivered is a different level of performance. These are 5-year annualized performances of our strategies. These are live strategies. So these are strategies we've actually been managing for clients. So gross of our fees, we've delivered a 5.9% return. So therefore, our alpha has been 5.2% above that passive benchmark. So the benefit of that tactical asset allocation I mentioned on the previous slide, selecting the building blocks, putting them together, using the model, is this difference. It's quite a significant difference. That's the benefit of using tactical asset allocation. And the same here for the dynamic, over a 4% excess return over the benchmark, over the passive. This is the passive return. In gray, this is the active tactical asset allocation that we have at Encore. So we're adding 4 to 5% excess returns. But finally, just to sum up, it is actually the client that matters to us and to all of us, hopefully, in this room. We've got to help our clients achieve their goals. We've got to help them not pay excessive fees. And particularly at Encore, we are very strong about this, not only in terms of the fee levels we charge, but also making sure that investors do not pay us twice. Asking the client, does the quarterly asset allocation work? Are they comfortable with the fact that their portfolios are being turned over tactically on a quarterly basis? And then finally, of course, are they happy with the returns? and the level of risk taken. So that hopefully sums up our approach on active versus passive and how we construct our portfolios. If any of you got any questions, please come up to me or my colleague Jan Cuban, who's here today, or contact us at Encore. We'd be very happy to help you and your clients. Thank you.